So I start with an apology. As Christina says, I'm techie. I've been nothing but technology companies for 35 years. So I'll try to be as relevant as I can to this fascinating assortment of businesses that aren't all about coding software. As part of that, I'll tell you one quick story about the one non-tech business I ever did invest in, which was back in '81, and that's because there is a financing lesson in it. And that is that a few of us thought we'd try to buy some income-producing assets. And Vancouver, forever, as you know, has lousy yields on things, and we couldn't find any apartment buildings we could afford or anything else. So we bought a rooming house, or we put in an offer to buy a rooming house on Main Street, better known as an SRO, single room occupancy. We thought, yeah, we can manage this. So we put in a firm offer, no subjects, fall of '81, and then we went around looking for bank financing. Should be able to it had a good yield, 3 times the yield of an apartment building. Should be able to put a mortgage on that. There wasn't a bank or an insurance company or anybody who would touch a rooming house. So come closing date, the end of February '82, we had to close with personal lines of credit. And my share of that was about a little over twice my annual income at the time. And by August of '82, courtesy of Paul Volcker in the United States trying to crunch inflation down, prime rate was 22 3/4, and we were at prime plus 1.5, so we were carrying this little property at 24.25%. It was a painful couple of years. So what your financing strategy matters is the bottom line. So as you know, there's broad sources of money. Money comes from all over: debt, friends and family, the professional angel groups, the venture capital firms, lots of people, and the TSX venture. There's lots of problems with it, but now that mining is dead, all the hot money that used to be in mining is now the hottest companies on the TSX venture at the moment are marijuana growers. There's 5 of them. They're trading at massive values. So there is money out there if you want to be aggressive. You were just hearing on the debt side, customers and suppliers. Not often, but sometimes, depending on the nature of your business, you can work out really interesting financing deals. Grant money is all over town for technology. It's a little harder in sort of non-tech businesses because it's not the flavor of the month. It's not clean tech and so on. But it's amazing when you look around at what governments are trying to do and social service organizations and so on. It's amazing the pockets of money. And you just mentioned
the Women's Enterprise Center there's a huge pot of money, like millions of dollars, to be accessed for loans more like 50 to 100,000 at a time, with more favorable terms, let's say, than a bank. Although they still require some of the same ratios and possible collateralization of a bank, but a little bit looser. So that's worth exploring too. And we can give, following this presentation, a bit of a summary of all the grant stuff that's available and those types of organizations like Women's Enterprise. And in fact, Stephanie, who's in the other class, that's what she does for a living, is help people find money through all the free sources, whether it's tech related or anything. There's not that many that are not tech related, but there are some. And so she'll be able to give us, I think we'll ask her to, right, Michelle, to give a sheet to the whole class on all those options.
And then this one's tech only, so you don't care about this for scientific research. So where do you start on all of this? And I always start with knowing yourself. What are you comfortable with? What do you like? What do you want to do? And the first one off the top is, even if somebody is interested to write a check to own part of your business, do you want ownership? There's a lot of nice things about being a sole owner of a company, or partners, 50-50 partners in a company, whatever. And there's a tremendous amount of baggage that comes with all of a sudden, it's no longer my company, but it's partnered with other people, and whether it's employees or outside investors or whatever. So you really have to think through how you want to manage your business, how you want to grow it. The second one is, you like life on the edge? 24.25%, or go slow. So you can go. You've got a choice in terms of how fast you grow, how you spend money, and then whether you do that with debt or equity or some combination of those things. And again, whether you've got other equity investors or lenders, even lenders want to see your financial statements and they want to come and visit. And there's an element of meddling that comes with other people's money, OPM from whatever source, even grants. You got to fill in the reports and say what you did. And finally, what are you trying to get to? Are you want to shoot for the moon? You want to build a big company and make tons of money, or you want to run a comfortable family-style business? And there's no rights or wrongs in this stuff. There's lots of good reasons to be one side or the other, or somewhere in the middle. The important message in all of this is to think through what it is you are and what you want and where you want to go. And finally, at the end of it all, are you building something you want to sell to a big food company for a bunch of money in 5 years' time, or is this something you'd love doing, you're passionate about, and there's no reason to ever stop till you're 80 or 90 or whatever, and it's a business? Because again, if there's no rights or wrongs, but if it's something you want to do forever, then that doesn't necessarily appeal to an investor who wants liquidity, wants to get their money back at some point in time. Right? And the second rule is related, and that's knowing your business from a money perspective, from the perspective of the lenders, equity investors. How do other people from outside who don't know you look at your business? And the first biggest issue is always scalable. Is what you're doing from an investor's perspective, is it scalable? Can it grow geographically? Can it grow? Can you find the people to scale what you're doing? Can you grow it financially? Second one is protectable. Is it, if you set up the same kind of operation instead of in Vancouver or Vernon or wherever, if you set it up in Seattle or Chicago, can you do that? Can you grow it? Or is it something that's regionally focused and not protectable? We're not tech here. If you're building it for an exit down the road, is your business something that's going to be attractive to future buyers? And you can typically look at most businesses and you can say, yeah, I know if I build this to $10 million or whatever, that this company will really want to own me. And other businesses, you look at it and say, no, I'm the heart and soul of the company, and Berks is not going to buy me, right? Just things like that. Steady. Some businesses are wildly volatile, scares the daylights out of people, or steady cash flow. And if you're trying to raise money or even borrow money for specific reasons, people really want to understand what those reasons are. What are the risks in the next phase of your growth, and what are the milestones? How do you know when you've reached those? Because from a valuation standpoint, it's when you reach another threshold, and okay, I've conquered the BC market. Now I've conquered the Canadian market. That's a value threshold. Now I've got some traction in the U.S. market. Those are the kinds of things that take money to get to, but once you're there, those are also the kinds of things that make you a more valuable company. Understandable. So there's a lot of businesses that are wildly complicated and very difficult to explain to people what it is you do. The easiest ones to finance are the ones that are the easiest to understand. And then putting the triangle together, the third one is knowing your investors. And it's really tempting, if somebody says, oh, here's $100,000 for your check for 10% of your business, and you go, great. But it's really important to know who they are. Cultural fit, and again, this applies to lenders too, because even bank lenders, there's some that are great and there's some that are tough to work with. So from a personality and culture standpoint, is there a fit? Do they add value to what you're doing? Nobody's ever repealed Murphy's Law. Things go wrong, and when you have to put out the bad news, how do they react to that? Passive or active, this comes back to no rights or wrongs. Sometimes you'll want somebody who's going to take a really active interest and spend half a day a week with you or whatever. Other times you want people hands off, let me do my own thing. So again, understanding the investor and understanding what you want is important. This one applies more in the technology world, I think, than here. The issue here is the investor's money their own personal money, or is it other people's money, like venture capital funds? And that has a very different style impact on in the technology world. Here, I doubt if you would be. I don't know a lot of VCs who are participating in your industries or spaces. And experience matters. And again, this one sort of ties in with this one, because the naive investor who has not been through a whole bunch of down cycles on these companies and so on, panic at the first the first negative sign, and you don't want that. And finally, if they've invested, if you don't know them and they've invested in other things, who have they invested in and who likes them, and it's a marriage. You've got investors are partners, and you really need to know them. So I call it reverse due diligence. Investors are doing due diligence on you and your business and your opportunity and your gross margins and economics and exits and all those things. It's really important to do due diligence, reverse due diligence, and figure out your bankers and your lenders and your investors and so on, because you can have them for a long time. So hierarchy of dollars. This comes sort of from the first slide upside down, because the best money is the freest money with the least administration. So tech companies get scientific research tax credits. It's on their income tax return. It's wonderful free money that costs nothing. Grants are harder because you have to find grant sources. You have to go through the work of applying for grants. It takes a lot of creativity to find those places. And then if you do get a grant from, for example, from where you're talking to, there's usually reporting obligations on how many jobs you created or whatever else that you were supposed to do with the grant money. But it's free money, which is nice. And then you get into this customer and supplier category, which it doesn't happen a lot, but it's really useful to look at your business and say, who buys from me? Who do I sell to? Who might have a reason to lend me money or accept payment on a deferred basis or do something. I'll give you a quick example. We've got a little business out in Langley that's is a soldier fly hatchery, and soldier flies consume organic waste, and they're going to consume pre-consumer food waste from Safeway and Overweighty and those kinds of things, 100 tons a day, and turn it into high protein feedstock for fish. So instead of feeding fish wild herring which is a depleting wild fish stock, it's a renewable fish food. And we've got strategic partners in that, from nurseries, from people who want to sell the byproduct as fertilizer, and half the money has come from suppliers who have a vested interest in getting rid of their food waste or or having access to the high protein fish feed coming out the other end. So it's just something to think about. And then you're into debt, of course, like RBC. There's a variety of so-called sub-debt people around that I think can fit into the kinds of businesses that you have. Business Development Bank, BDC, has a sub-debt group. Espresso Capital in town is more high-tech oriented, but you tend to find in most municipalities that there are groups. They tend to fly under the radar, tend to be 2 or 3 or 4 or 5 individuals who do some form of high yield lending, a little bit below the banks. You don't have receivables or inventory that you can get bank lending for, and so instead of prime plus 2 or whatever it is, it's 7 or 8 or 12 or 14% interest money, but it's non-dilutive, provided that you can sleep at night with having debt on your balance sheet, which does need to be repaid someday. And then you get to equity, which of course is where I spend most of my life. So it's by far the most expensive because you're giving up part of your company. It's the most difficult. It takes a long time to explain to people what you're doing, and the most reporting. It's not just financial statements. People want to know how your business is doing, but it's safe. If something goes wrong, you're not in bankruptcy court, and it fuels moonshots. If you really want to go big, there's no substitute for raising a lot of money. Well, a partnership is a legal term. So if you take it out of the legal term and you use it just generically, yeah, equity is very much a partnership. If somebody buys 25% of your business, you own 75%. It's in terms of function, it's a partnership. In a legal sense, a partnership is a legal partnership where it's a different vehicle, but that person owns 25% of something and you own 75% of something, as opposed to a corporation. But if you have a corporation and they own 25% of your business, then yes, think of them as partners. This is interesting just in terms of the marketplace. It's been a dry spell in a lot of places for 10 or 12 years. The only point of this slide is that there's a lot of money flowing around at the moment looking for investment. Bank interest on bank cash in the bank is next to zero, and a lot of investors, a lot of these companies, Layer 7, Vigilon, they were around for 10 years. People had their money locked up for that period of time, and then exits do happen, and it's been a great year and a half, and 2015 is looking like another great year. So there's lots of liquidity in the system looking for interesting places to invest, and public markets are great. So.
Can you explain what I'm looking at?
Oh yeah, I'm sorry. So I'm sorry. So all I was doing was saying these are all companies that have had liquidity events in the last year. So Hootsuite, Omer's bought $20 million worth of shares from the founders and other early investors. And people tend to recycle their money. So all of a sudden, those people who had paper the day before now have 20 million of cash, and they've been investing in other businesses around town. So in 2013, Layer 7 was a company that was funded back in 2000, sold to Computer Associates for $157 million. So, and all Vancouver investors, 100%. Partnerpedia sold last year for $30 million. Vigilon went public, and today has a market cap on the Toronto Stock Exchange of $1.3 billion. So the point is that all the people who invested in those companies, and these are 3 transactions that are going on right now that will get sold before the year's over, and these are companies, Vision Critical and Hootsuite, that will probably go public next year with those kinds of values. So the point is that investors in all those companies are now either have or are looking at having lots of cash, which they tend to recycle into the next interesting business. Liquidity. So money's out there. You have interesting business. What do angels want? It's most first, second, third, all about the people and who's executing, because nobody wants to have to run the business. Team's domain knowledge. Do they understand the business well enough to? Comes back to this marijuana. The marijuana grow-ups. They're spoiled. They're failed mining companies. They were looking for gold in the Yukon or wherever and couldn't find any, and nobody wants to put any more money into them. So then say, well, let's grow marijuana. There's a domain knowledge issue in there.
I think there's a market for it.
Yeah. Well, there's another public mining company that has switched to putting the Bitcoin ATM in town, right? Trying to create a business out of Bitcoin ATMs. Scalable. This is one of the biggest ones. Is it something that grows to a size where it can ultimately be sold, or you can get your money out or get returned? Does something grow? And similarly, liquidity scenarios. If you invest in this business, how do you get your money out down the road? And if it's something you want to run till you're 80 or 90, that gets hard. Something unique, and in the technology world, it's kind of easy to think in terms of uniqueness, intellectual property, patents, technology, whatever. But in your case, a lot of these businesses lend themselves to franchise-type models. 1-800 got junk started here, right? And Lululemon obviously was not a tech company. There's lots of non-tech quality stories around, but there's got to be something novel, unique, special about the business model that says, this can grow and survive over the long term. Capital efficient means that it doesn't take a lot of money to grow. So we've got companies like General Fusion who's building nuclear fusion reactors. They've gone through $100 million so far. It'll probably be $1 billion by the time they reach break even if they do. Same with D-Wave, which is making quantum computers. They're well north of $100 million. Those are hard deals for angel investors, even at the beginning, because you start small, but you know that the company's just going to have to forever raise money. So if you've got a business model that you can see growing with modest amounts of money, that is very attractive to individual angel investors. Again, understandable, and the key part of in this area, the key part of being understandable is networkable, because everybody typically. Individual investors like to co-invest with others, not just be the sole investor. So if you're looking for 2 or 3 or 4 people to come in together, they need to be able to talk to each other and explain what they're doing at a cocktail party and rope the next person into the deal, that kind of stuff. So the simpler and the more understandable, the better. Something that's interesting is good. Something that's good is good. Everybody likes to do something with their money that's good rather than just make money. And most of all, it's got to be fun. So that's the relationship and the culture and all those things. And the one exception is your Aunt Tilly. If you've got a rich Aunt Tilly floating around, she probably doesn't care about any of those things. And you can raise money. And a lot of family businesses get funded that way, and that's great. And then this gets a little bit technical, but it's significant. And because at the angel level, you often have a level of naivety on both sides, both angel side and entrepreneur side, that some really crazy deals get done. And then you realize a year or two down the road that it was a crazy deal and it's not good for anybody, and then that becomes a source of friction. So you really want to start you want to start out with something that's fair. So the first one is valuation, is the value that you're placing on your business reasonable and fair and that kind of stuff. The priority issue, what sometimes happens is locally, particularly in the tech world, but others too. Somebody says, okay, my business is worth $2 million, and this is Dragon's Den stuff. For $200,000, I'll give you 10% of my business. So somebody says, great. Writes a check for $200,000 and owns 10% of the business. 3 months later, you get tired of it, something goes wrong, and you sell the business for $1 million. At that point, the investor gets 10% of $1 million, $100,000 back, so they've lost 50% of their money. But the person who started the business 6 months earlier gets the other $900,000 for nothing. Well, not for nothing, I mean, started the business, but it wasn't a success. And so you get this disproportionate return. So what happens in a lot of early deals is that people say, okay, if the business is sold for less than that initial $2 million, get my money back first, and then you can have the rest.
Over a certain period of time, usually? Sorry, or like, so, or as a forever
just if it's sold.
agreement?
Just if it's sold. Whenever it's sold. Pro rata rights of future rounds doesn't matter here. But, well, yeah, it does. If you're going to be growing the business and you're going to be raising more money as you hit milestones and as you grow from BC to Canada to the US and so on, an early investor likes to have the ability to continue reinvesting in subsequent rounds and not just kind of get left out. Because sometimes some of the most attractive rounds are actually later on when you've got the confidence that the business is really working and it's going to keep growing, and you've gone from 2 million to 10 million, whatever. So not to be left behind. Reasonable due diligence. This just, at the angel level, nobody expects to come in and go spend 2 weeks, like a venture capital firm, go spend weeks going through your books and talking to every one of your customers and every one of your suppliers and all of those things that professionals have to do because they're managing other people's money, so they have a fiduciary obligation to be ultra careful. When it's your own money, a lot of that doesn't matter. You're much more inclined to go with your gut feel and your assessment of the quality of the people and the opportunity. But you still need to be able to ask a few questions and not be told you're an idiot for, trying to figure out the business and what it is you're investing in. Similarly, on documentation, where a venture capital shareholders agreement might be that big, and so on, at this level, you don't want to be doing that. But equally, you don't want to take the check and sign something on the back of an envelope. You want to have a lawyer involved and have a clean and simple agreement with whoever is in, just so that there's no misunderstandings. If you're taking equity investment, then you want a professional board of directors. It doesn't have to be the investor who's on it, but somebody wants to know that the company actually has a board of directors, and this comes with the baggage associated with, do I want outside equity or not? But if you are going to take outside equity, then you really need to think through governance, proper governance, and who sets your annual compensation and those kinds of things. So there's a level of professionalism that gets drawn into it. Same with reporting. Again, it doesn't have to be wildly detailed, but most angel investors or individual investors at least want to see some brief quarterly financial statements and a bit of a quarterly report on how the business is doing. Oftentimes, particularly if tech companies raise $500,000 first from angels, and then they raise $10 to $20 million from venture capital firms, all the attention goes to the VCs, and the angels once a year get a legal AGM notice or something like that and have no idea what's going on. It's very frustrating. And overall good housekeeping and just in terms of how you run the business and how you do reporting statements and respect for the fact that somebody has put money behind you and your business. So where do they hide? How do you find them? This is what most people want to know. The most important point is that the herd instinct's alive and well, and it comes back to this point of people liking to do it in 2, 3, 4, 5 angels in a group as opposed to doing it solo. It's like everything else. More minds are better than one, and if a few guys or girls can get together in a room and talk about a business and share their thoughts on the risks and the issues and the upside and so on, it's good. So you want usually several, and the starting point is all, who do you know, who knows you, who have you worked with, not necessarily that they have the check themselves, but it's all about credibility and reference and personal knowledge and so on. So who knows you and who do they know and who do they know? And eventually as you work through that chain, you find somewhere in there that somebody who actually does have check writing ability and is interested to be an investor. There's professional organizations. Angel Forum is a group that showcases 30 or 40 companies twice a year, and Vantech is all technology, but it's every first Tuesday of every month. Angel Forum has lots of tech and non-tech companies in it, clothing companies. I was looking at one yesterday which is trying to be a Lululemon for men, because men don't shop at Lululemon. What?
I said with the see-through pants.
Yeah. No, a completely different set of materials. There was actually at the Keiretsu. So the Keiretsu Forum is an international angel networking group, and that's where it's called SOTO. They were presenting the Lululemon for men idea.
Where are they from?
Seattle. They're actually operational. They've got their first kiosk going in Seattle, and you can buy SOTO clothes, high tech athletic wear for men. Powerhouse is tech. We won't. And so what it really comes down to at the end of the day is networking. It's finding the first person and using them to help you meet more people and getting groups together and just building a bit of a buzz. And it's just there's no easy unless somebody happens to write a check on the first meeting. Count on it being a lot of work to meet a lot of people and tell the story and get there. And then I was told I had to have 5 takeaways. So there's the summary of what came before. Know yourself, your business, your investors. Be fair. Network.
What happened to your rooming house? Did you end up making money off it?
There's 2 parts to the story. One is that we did survive financially. We sold it about 5 years later at about break even. But the other part to the story is we had no domain knowledge. We knew nothing about running rooming houses. And being fairly handy with power tools and so on, we thought we could do everything we needed to do. The first time I was fixing an electric light bulb on a step ladder in a room, I had just turned off the circuit breakers outside, and somebody came down the hall and didn't think the circuit breakers should be turned off and turned them back on while I was holding the wire up top. And about a year after that, the phone rang at home, and it was the manager. And Frank, and he said, "Dave, Mrs. Fletcher, it's Frank. Is Jimmy there?" And Casey says, "No, Frank, he's in Toronto." And Frank says, "Oh, well, just when he gets back, just tell him I've been stabbed." So there were enough of those stories that when we had an opportunity to get out, break even, we did. So.
What is the best way to approach a group of angels? Is it to invite them to a sit down where you've got your PowerPoint and you do a whole pitch, or is it that you're conversationally connecting and then go for coffee?
Well, initially, in the very beginning, it's the first, for sure. And until you get a little bit of momentum. The key is to find that very first person who says, "I like it," and then build on that momentum. That's sort of the herd instinct. So the first one is however you find them. And then they have friends and so on. And then, probably 2 or 3 meetings down the road, you're into a meeting room with a laptop and a PowerPoint deck and those things. Or if you're doing it through one of the forums, like if you're doing it at an angel forum, then for sure you've got your 8 minutes of glory to tell the story and compete with 30 others. Dragon's Den style, right?
How do you get to an angel forum then? Do you have to be invited? Or?
No.
Okay.
There's a website, and you just send in an application. It's fairly inexpensive. I think it's $300 or something like that. Yeah, that's a really good question, and it's a completely different category of person from this. This has been me. I've been talking mainly about financial investors only. For what you're talking about, there's a completely different channel that I have no involvement with, but it's basically known as the business brokers. And the business brokers buy and sell companies like yours and others all the time. And they also have as clients people who come in and say, "I've got $10 million and I want to buy a business. Find me a business." So they have both buy-side clients and sell-side clients. And if you were looking for a financial partner that you also wanted to help you grow the business and be a CFO or be head of sales and marketing or something like that, that's where I would go. I'd go to the business brokers. You can find them in the yellow pages or the equivalent thereof these days.
We've got a bunch of all of them we can tell you about too.
So for you as an angel, you're looking for a business that is going to sell, or it's going to go public, or some way of getting sort of a short-term return on, or maybe not necessarily short-term, but foreseeable return on your.
Yeah. Most of those companies I put out there, I said, this is the year of the 14-year overnight success stories in town. There's a lot. So a lot of people have been in a lot of these companies for 10, 12, 14 years, which is fine, but it's not forever.
Right. Dividends over those years?
Nope, not in technology.
So that exit strategy is part of the pitch for you? Like you want to see the value in how they're going to.
Yeah. And people rarely know for sure at the beginning what an exit's going to look like. So it's not so much saying, here's what I'm going to do exit-wise, as having a feel for whether there is an exit.
The potential.
Right? Whether somebody will, in fact, want to buy, whether there will be buyers.
And so I work with, like, a couple of my clients in the last few years have been acquired, and for significant amounts. But in the beginning, and even to me as their PR rep, they've told me like they have no intention to go public, or they have no intention of being acquired. Do you think they've said that to their investors, or for you as an investor, would you have invested in them at that point? Because they did have, some of them had angel investors from the very beginning, but that was how they had articulated their intention.
That's usually a pretty big source of conflict.
Right.
Maybe they didn't say that to their investors. They
Yeah,
said it to you.
It's been said, yeah, it's been said to me, and then you see a couple of years later, and you're like, yeah, we expected that to happen.
Yeah. I mean, there's absolutely nothing wrong with lifestyle companies. I think they're fantastic. But if it's a lifestyle company, then it needs to be financed by lifestyle people, Aunt Tilly or your mother, your parents, or whoever is in the family network and is doing it as part of a family business.
Or debt financing.
Or debt financing.